Hey everyone, welcome to CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data, which you can pick up in the description below or here on my homepage on Patreon. Access to the CoveredCall ETF ALLSTAR tracker. Just accelerate your education with exposure to all these different CoveredCall ETFs from performances, what the covered calls are all about, find opportunities here. It's a great tool. It'll cost you about $13 to at least just try it out for yourself. But I think it's a worthy tool to get started on your income investing journey. And also too, I update it on a monthly basis. So that next update is coming out on March 1st, which is going to include 57 American covered call ETFs. And I'll continue to chug out more funds month after month. So like I said, new release every first of every month. So with that being said, let's actually get into what this video is all about, which is, for me, is reviewing three funds. I'm not going to go massively in depth with them, but I want to give you guys sort of the gist of what these three funds are all about. They're kind of interesting. Basically, why I wanted to review them is that I am in the marketplace for some American covered call ETFs for fund manager diversification reasons, especially my RRSP. I have here three funds that I wanted to review that I could potentially invest into. So one, they have to have the underlying, ideally if possible, which with a lot of American covered call ETFs, stability, whereas a lot of them are variable, over 10% yield, of course, and of course just be diversified as best we can. But of course, in the grand scheme of things, sometimes you sacrifice one or two of those things, but ideally you get as close to, the rules you put in place, the guardrails you put in place for yourself. So let's look at the very first fund. So anyway, the three funds we're going to review are FEPI, ISPY by ProShares, and we'll look at GPIQ by Goldman Sachs. And like I said, we'll do I'll just kind of give you all the gist of it to make sure this video is tight and it's not gonna just overwhelm you guys with info. So why I like FEPI, or what is interesting about FEPI, is it has this 25% yield currently. It recently came out with a distribution that is, I think it was, where was it here? It was somewhere around here. The distribution was $1.19. There it is. And if you look at their distributions, fairly stable. Now, I guess if you want to call it the drawback, depending on what you're in the marketplace for, it's a tech-focused covered call ETF. It invests in 15 stocks that it owns. Oh, I should say, unlike YieldMax, where you basically are getting the exposure to the price for a higher yield. FEPI kind of gives you this idea that it is based on a YieldMax style structure, but whereas with YieldMax you don't own the underlying, here you actually do. Although I must say FEPI is kind of, if you look into their prospectus, it's a little vague as far as how they are able to generate this much higher yield. As this plays out month after month, I'll continue to watch it, but I am getting a lot closer to wanting to add an American covered call ETF into the portfolio. I don't think it'll take away from HYLD.U, which is 100% of my basically retirement account, but I will probably let it diminish a little bit in the hopes to diversify into things like potentially something like FEPI. Again, very interesting. Its AUM has grown like crazy in the last couple of months when it was initiated, which is 112, well, call it $113 million. The guys over at RRSP did actually reach out to me upon the launch of this fund, and through multiple reasons, we weren't actually able to do basically a one-on-one. So Scott, if you're out there from RRSP, let's make this happen. FEPI is a really awesome fund that I'm very interested in. It's awesome in the sense that I'm interested in it and trying to understand what this thing is all about. At any rate, 65 basis points, it falls in line with a lot of other covered call ETFs, so fairly standard. RRSP is, I would say, is probably a lot newer. I think they're based in Florida. been around, I think, since 2018, so a lot newer. So for those who are concerned about, a fund manager having some history, I mean, that's just going to come at the cost of perhaps having that higher yield. But anyway, something to continually watch month after month with those distributions. And next up, by ProShares, we got ISPY, the S&P 500 high income ETF. First ETF powered by daily call options strategy. Is it? I don't know about that. Isn't YieldMax doing that? Anyway, so whether you're first or not, it doesn't really matter to me. Basically, this ETF, with its one distribution, it's yielding about 13.87%. So investment objective: ProShares S&P 500 high income seeks investment results before fees and expenses that track the performance of the S&P Daily Call Options Index. ISPY gains exposure to the sale of daily call options by using swap agreements and does not trade options. So I'll explain exactly what that objective means as we kind of roll through the fund here. Slightly less expensive as far as a management fee, with 55 basis points, whereas FEPI was 65. It doesn't actually give us the AUM, which is kind of interesting why it doesn't do that. But I think if you download their holdings, I think it should give you the nominal value from that. Let's see what else. There's nothing really else here. This is another fund that where you actually hold all of the underlying, which I really like. So again, if you're comparing ISPY to FEPI highly concentrated in those tech funds, trying to mimic the FANG Sole Active Index, which I think I forgot to mention with FEPI. ISPY is trying to replicate the S&P 500 daily call options index. So in order to do that and to make this really simple for you guys, here's the breakdown. It holds all 500 companies from the S&P 500. So, but you'll notice, what does this 100% mean? What does the 17% mean? It has no market value, but yet you have basically, so for the sake of, and all intents and purposes, for the S&P 500, just ignore this 100% and the 17% weight. What this fund does, it holds all 500 companies, and then it doesn't write any call options on any of it. And because like different fund managers, like YieldMax, like again, this is it kind of smells of YieldMax and defines ETFs, but they all kind of do it a little bit differently. So what these guys do is they hold all 500 companies, right? No call options on any of them, but then they use swap agreements and futures contracts to basically replicate the performance of the daily call options S&P 500 index. And then why they hold this is to use that as collateral in case say the futures contracts and swap agreements, if something doesn't quite go ISPY's way, well, again, they can use this as their collateral. One of the benefits of doing it this way is you still get the dividends produced by all of these companies, and because you're not writing call options, you can get that fee down a little bit lower, down to, I think, whatever it was, 55 basis points. Now, I think just to quickly chat about like other funds that do something similar like this, we know Defiance, they use puts, I believe, to get exposure to the daily call, to get exposure to that index, that daily S&P 500 CoveredCall index. So there's a few things that they do there, and then YieldMax, basically they get price exposure through various mechanisms, because one thing you can't do is, right now you can only do daily call options on the indexes, and you can't do them on individual companies. So ProShares and YieldMax and Defiance ETFs, what they have to do is they have to involve, there's a lot more complexity around that. And to me, I'm not the biggest fan of complexity. I think what that means, whether the fund manager is well-meaning or not. It's just there's just more availability to say hide or manipulate something behind the scenes to make the fund maybe look better than what it actually is. For the most part, I understand what ISPY is trying to do here. Again, you hold all 500 companies, swap agreements, and futures contract get you the exposure to that daily call options index, and this is used as collateral as the gist of it. And currently yielding 13.87%. So again, very interested in that, and it's fairly new, so we'll just probably wait another couple months potentially before I invest in either FEPI or ISPY, or maybe I find something else that I like. And last up is what I like is in my wheelhouse, just a plain Jane kind of boring boring in the sense that in the way it's structured. So GPIQ, pretty easy to understand here. Not much to go over. It's been around for a couple months now, 2 months roughly. AUM almost $36 million. So GPIQ is trying to compete with GPIQ, which has something like $30 billion in assets under management. GPIQ also has a companion fund, GPIX, which tracks the S&P 500. This one is more akin to the NASDAQ 100. And it has a low gross expense ratio at 0.35, similar to GPI and GPIQ. I compared it to GPI. I meant to compare it to GPIQ. It currently yields as of making this video, it's at around 10.3% yield, which again, I like. It owns its own underlying. It's weighted obviously pretty heavily naturally in information technology and communication services, with 48% of its holdings in the top 10 companies. The number of holdings is about 100, which you can download here. This fund takes a dynamic approach, which many fund managers do. Basically, a fund manager can either go dynamic or rules-based, or maybe another word for that would be systematic. With dynamic, they can basically change the portfolio coverage. So in this case, GPIQ does 25 to about 75% coverage. So 25 to 75% portfolio coverage, and it can do at the money, out of the money, in the money if it so chooses to. It's totally based on how the fund manager sees fit. Now, on the opposite side, because this is dynamic, systematic approach would be like a lot of the global X funds. They do monthly call options, and it's set every single month without change, no matter what the market is doing. So that would simply be more a systematic approach, whereas these guys, obviously, they change their portfolio coverage. The global X funds don't change their portfolio coverage. If it's 50% coverage, that's what it is. If it's 100%, it does not change. So other than that, I mean, again, fees, the lowest of all these funds that we just reviewed. Its yield is, yes, it's the smallest, but its yield is actually higher than GPIQ and GPI. Its yield is also higher than GPIX, that S&P 500 version of GPI, which is also that Goldman Sachs GPIX. So it has the highest yield of kind of all these JP Morgan, Goldman Sachs, CoveredCall ETFs. Just hanging in there, 10.3%. Again, similar feed to those JP Morgan funds. And you know what? It's assets under management. Right there, it's not explosive growth, but hey, it's growing. We'll track it over time in the CoveredCall ETF ALLSTAR tracker. Again, these are three funds I'm interested in. They each have kind of their own unique characteristics. JPIC, just boring. It's standard. It's what I like actually. It's over those more kind of complex funds with swap agreements and futures contracts, or in FEPI's case, kind of more ambiguity around how they're able to attain a much higher yield. But I mean, for your own research, hopefully this can at least be a launch pad for understanding of these three funds. So as always, if you like what you saw, do the cliche thing and hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.